All right, everybody, we're back with the Insider and the venerable Mark Chin on today, Friday, October 28th. We were talking about risk and reward here in New York City. Obviously, Mark, we're seeing some inventory levels and lots of price corrections pick up in a lot of these markets across the country. But here in Manhattan, we're seeing a relatively stable market with historically normal contract levels. There are some recalibrated expectations on the part of sellers who are getting a bit more realistic. But what are we seeing as far as the data is concerned?
Yeah, so about a year ago, the Bloomberg published an article which talked about the risk-adjusted return of the various cities in the US. And okay, so New York City doesn't perform as well as others when the market is super volatile, but on the other hand, it also outperforms when the market goes down. So the market doesn't go down as much in New York, doesn't go up as much as in New York. So when you normalize New York City returns to volatility, it is the best risk-adjusted returns in the whole country. And I think even though that this article was published a year ago, I went back to look at it again in the context of what actually happened in the last year, and I thought it was instructive. So let's take a look at some data that came from UBS. They do a global real estate bubble index every year, and they just published this week. And what you'll notice is New York is pretty far down on this list and ranked number 20. Many cities ranked much higher in terms of bubble risk, as you can see.
Well, it's interesting that actually Singapore is rated number 21, right behind New York, followed by Milan and Dubai. Singapore and Dubai, I've always thought of as being, fairly not speculative, but pretty heated with fewer conveniences than New York.
Yeah, I felt that when I used to live in Hong Kong, and when I was there, the market was like you'd have 35% down in a quarter, and it was like very weird to me because I was used to New York City as the norm. But when you're over there in these smaller cities, that they can be very, very volatile. But I think one of the things to look at here is number 10 is Miami, number 11 is Los Angeles. Number 17 is San Francisco. Number 18 is Boston. So you see a lot of the a lot of the U.S.-based cities in much riskier situations than New York City in terms of their bubble risk.
Well, Miami, of course, we saw huge inflation because a lot of people from up north were migrating down there during the both during and immediately following the pandemic lockdowns that we saw. And of course, that trend is reversing in many cases. A lot of the people that I know who moved down to Miami are actually back already for one reason or another. And I was down there about a year and a half ago, and the traffic was unbearable. I don't think that the Miami infrastructure is really built for that type of population. I'm in touch with a lot of people, both on the East and West Coast, Jacksonville on the East, of course, and Naples and Sarasota on the West. And we're definitely seeing some adjustments down there in terms of inventory levels rising and those recalibrated expectations from a value perspective. So, it's interesting, though, because New York is one of these tried and true markets where people look to it for sort of inflation hedge. And it reminds me of the renewed interest that we're seeing the last couple of months with all this volatility in the stock market in treasuries, right? Mm-hmm. And New York is somewhat like the treasury of not only the United States, but also from a global perspective in terms of the property values, as long as you don't get too speculative with the ultra high end, like the 220 Central Park Souths of the world and the Plaza. But as long as you're looking for blue chip properties, this is right in line with that type of thought process.
I think that's an excellent point, Josh. New York City because it is a city of renters, it really is the mega market for multifamily. And no other city even comes close in terms of its scale. So in New York City, at least in the multifamily market, this is not talking about condos and co-ops, but like rental buildings, it is the blue chip market for that kind of property. In the US, there is no second place. There is nothing is even remotely close. So from that perspective, absolutely. And then, of course, when you're talking about condos and co-ops, the story also applies. So let's take a look at some market data here, just about contracts signed. This is data that the Insider is collecting for our readers and our viewers. And what you're seeing is a decline in contracts signed. Tell us what you make of this, Josh.
Well, I wanted to pull this data, Mark, because it really gives us a sense in terms of real time of what is actually happening in the market. And, this looks at Manhattan from the perspective of real time activity. And it doesn't tell us that, things are necessarily in this malaise and no one's doing anything. We just sent a contract out this morning for $4.5 million on a property that's been on the market all of 5 minutes. And, it's great because it's perfect for the people that we're working with. They've been looking for some time. So they recognize value and quality when they see it. And they stepped right up and, without giving too much away, because it's still early stage, we're within 5% of the asking price. So it's fairly priced. And, as long as the buyers are educated and the sellers are realistic, deals are being done. And so when you lay this over the activity from the prior year, you're going to see that this is actually historic normal levels. Obviously, we had a very active first and second quarter, but for the third and fourth quarter, a lot of people don't understand that when you come back from Labor Day, people think you're going to get right back to it and activity is going to pick up from the July and August doldrums. But in reality, people are focused on two things in September and October in Manhattan. That's one thing, getting back to school. And the second is the Jewish holidays. And between the two of those, we see activity slow to the lowest levels of the year after year, regardless of what's happening in macroeconomic conditions. So we're seeing that activity pick up. We're seeing showings pick up, offers being made. And some of the offers that are being made, by the way, were being trumped by higher offers. So
yeah, and I think this is super interesting and super important because a lot of the data that we show is lagging the market a little bit. I think many people that are readers of the Insider realize this, but some people don't realize that you are the single largest purveyor of aftermarket properties in New York City. So the number of units that you see as the head of the Rubin team is more than anyone else. And so in a lot of ways, what you see at the top of the pyramid there is kind of like a bellwether for the market. And it's been busy the last couple of weeks, right?
Yeah. I mean, we've definitely been active and we've seen a palpable shift in people coming back into the market. There's still fear out there. Don't get me wrong. There are a lot of people who tap the brakes and they're sitting it out and seeing what happens. But what's interesting is we're not seeing a lot of quality inventory come on. And when there's true uncertainty out there, activity picks up like it did in the summer of 2020, where we were at a 10 or 12 year high in inventory levels. That got absorbed, but we're not seeing sellers capitulate and throwing in the towel and saying, hey, get me out of here. This is the best I'm going to get. And instead, we're just seeing buyers be a little bit more hesitant. But as long as people have a long enough time horizon and they recognize quality and value, they're going for it.
I think that's worth double clicking on again, Josh, because what we're seeing is smart money is coming in and starting to do stuff. People that have a need do things, and people that are like financially savvy are coming in to take advantage of the market here. Now, it's a complicated story. This is not a one-way story, right? We've got this potential recession situation that we're either already in or about to be in. We've got layoffs in Wall Street and tech, and yet let's take a look at some of the stock prices of big companies that sell real estate. So a lot of people don't know that Realogy renamed themselves to Anywhere. And so that company owns, let's see, Century 21, Corcoran,
Sotheby's.
Sotheby's, yep. And as one of the, I think they have like 450,000 real estate agents work for them. So they're a sort of a bellwether for what the big brokerages are doing. Also up here, we have Redfin and Remax. So 3 large brokerages and that are publicly traded. And in the last 5 days, these stocks have been up big. This is just 5 days. So Anywhere is up 7.5%, Redfin up 16%, Remax almost up 6%. And what's going on is the market is starting to realize that this cycle of the Fed tightening and raising interest rates is coming to an end. And so I think that if you are, as you just pointed out, if you're forward thinking, this is a very good time to buy because the market can turn on a dime here.
Yeah, no doubt. It's interesting because, as we know, the stock market is forward thinking, but when we actually look at the underlying conditions, it was only 2 weeks ago when the Bank of England was on its knees, and Liz Truss had to step down. They quickly put in her competitor over the summer, who everybody was poo-pooing, but it turns out that Rishi was right, and he stepped right in, and he seems to have gotten them back on track. So we'll see how long or how well he's able to do that.
Yeah, he's a banker, so he understands the money flows very well. Yeah.
But what's important is that as of today, we seem to be on more solid footing. Now, what do we think is going to happen as a result of this most recent September GDP report that we saw come out the other day, which came in a bit hotter than expected? I think it was about 30 basis points higher than analysts expected. And I think look, my sense, Mark, is that it puts the Fed in an awkward position because, if anything, that signifies that the United States economy is actually better than a lot of people thought, at least from the outside looking in. Now, I could be wrong.
I think you're right. And the first thing that happened is the stock market took off because people were like, "Oh my God, we're not in a recession. This is great." And then the second order effect was the stock market came back down when people are like, "Wait a minute, this probably means that interest rates are going a little bit higher." It's still my sense that we're near the end of that tightening cycle, though, and we need to keep an eye on that as things go forward.
Yeah, I don't know that we're at the end of the tightening schedule, but I think that we are going to see another 75 bip raise. A lot of people are saying that we have a few more to go. Now, what happens after this next raise and whether or not we see a couple more 75 basis point increases remains to be seen. Are those subsequent raises more in line with, say, 25 or 50 basis points? But I think we just need to really keep our eye on the CPI, which the most recent print a couple of weeks ago saw the market sort of vacillate. We were down big and then came right back that same day once the public and the street had a chance to really dig into those numbers. But I think that we're still in for some volatility and uncertainty. I don't think we're totally out of the woods.
I think that's right, and I think it's a good place to wrap it for our viewers today. Everybody, it's fantastic to see you here on The Insider, and we'll see you next week.
Have a good weekend.